If you look at the history of explosive real estate growth globally, the pattern seems pretty consistent, doesn't it? The really big opportunities, the transformative ones, they don't always pop up in the obvious core markets everyone knows. They tend to emerge in these calculated rising peripheries.
That's exactly the insight. Yeah.
Yeah.
We're talking about markets where you see this convergence of ambition, serious infrastructure spending, and, well, capital inflows happening before the market fully catches on, before future potential gets completely priced in.
Right. Like Dubai Marina back in the day. Or maybe Shenzhen.
Precisely. Those were the peripheries then. Now they're the core.
And that really sets the stage for our deep dive today. We're focusing on what looks like one of the clearest examples of this playing out in the Gulf right now. Al Marjan Island, AMI, in Ras Al Khaimah, or RA.
Exactly.
And we're aiming to go beyond just the brochures, you know? This is more of a strategic analysis of its rise.
Yeah, we've distilled the source material, which interestingly uses the BNW Pelagia development as a key case study. So the mission today is to understand not just that specific project, but the bigger shift happening, the geographic and economic movement in the Northern Emirates, how things evolve from mature markets like Dubai to growth frontiers like RAK.
Okay, so let's unpack this. AMI, we hear the name, but what is it physically? Are these just natural islands?
Oh, not even close. No.
Yeah.
AMI is completely engineered. It's an archipelago, 4 islands actually, shaped like coral. They stretch, I think, miles out into the Arabian Gulf.
Wow.
It's a massive, intentional, multi-billion-dollar undertaking, really designed to completely change RAK's coastline, and maybe more importantly, its economic position. It's a very calculated move to shift RAK from being, a quieter emirate to a high-value global spot for tourism and investment.
So definitely not organic growth. This is planned economic stimulus. We've seen similar things, obviously. Palm Jumeirah, Yas Island, huge successes. What makes AMI's situation different or tailored?
Well, it's definitely borrowing from that success blueprint, sure. But it is tailored for RAK's specific goals, maybe its target demographic. What's really driving it, according to the analysis, are the structural commitments. The source material points to over $3 billion committed just for island infrastructure and tourism development.
$3 billion. That's a serious commitment. What does that kind of money actually build? What does it buy on the ground?
It buys the foundations, major government-backed infrastructure. Think massive upgrades to road access, utilities, and critically refining the regulations. RAK is actively aligning its legal framework to make international investors feel comfortable, offering long-term certainty. And then, of course, there's the influx of big global hotel brands signing up to build new resorts.
Right. That structural underpinning is what pulls in the serious capital. The analysis used this phrase I liked, early stage inefficiency. Can you translate that? What does it mean practically for someone listening, maybe in terms of numbers?
Sure. Inefficiency here basically means the market isn't, let's say, perfectly smooth yet. There's potential for outsized returns because valuations haven't fully baked in what's coming. So, for example, if comparable waterfront property in, say, a prime Dubai spot trades at $1,500 per square foot, AMI might still be significantly lower, maybe 25% to 40% less. That difference, that delta, is the inefficiency. It lets investors get in before the destination fully matures and those yields tighten up, gives their capital a running start, so to speak.
Okay, that makes sense. And it brings us down to the micro level, to the specific case study. BNW Pelagia. We've got the picture of AMI growing fast. But what makes this particular development, Pelagia, a smart or calculated entry point?
Right, so Pelagia, it's pitched as a premium waterfront residential project by BNW Developments. And it's really positioned at the intersection of all those macro forces we just talked about. Yes, the architecture looks appealing, contemporary design, resort amenities, but its strategic value, that's almost purely geographic.
How so? How does its location exploit that early stage inefficiency we were just discussing?
Well, it boils down to securing prime, genuinely limited coastal real estate quite early in AMI's development cycle. By getting into the market now, investors are essentially buying direct exposure to the capital appreciation that's expected as AMI matures. I mean, if the island delivers on its potential and that price gap with Dubai narrows over, say, the next 8 to 10 years, Pelagia investors stand to benefit significantly because their initial cost base was so much lower. It's a leverage play, really, on the whole island's future.
Interesting. The analysis highlighted 3 specific economic trends converging right where Pelagia sits. Let's break those down, starting with where the money's moving.
Okay, first trend, the migration of capital northward. It's pretty straightforward. As prices in prime Dubai keep climbing and yields get squeezed tighter, investors, both institutional and sophisticated individuals, they start looking elsewhere. They need diversification, better potential returns. RAK, and AMI specifically, is engineered to capture that capital overflow.
Makes sense. And the tourism angle is huge, obviously. That
Yeah,
must be the second trend.
exactly. Tourism-driven demand, RAK's big push into tourism, especially with the Wynn Resort, the region's first integrated resort, that's a massive catalyst. That kind of project brings a huge economic multiplier. International visitors, high-end spending. It's expected to seriously boost short-term rental demand across the island. And that's absolutely critical for residential projects like Pelagia that cater partly to that market.
Okay. And the third piece ties back to the groundwork, the infrastructure.
Yes, the third trend is fundamental, infrastructure-led appreciation. Real estate value doesn't just appear out of thin air because the view is nice. Value goes up because the government delivers the essentials, the roads, the power, the water, the connectivity. As these links are completed, it directly increases the intrinsic value of the land and the properties. And importantly, it improves liquidity, makes it easier for future buyers to access and transact.
Right. And just to connect the dots back to the numbers, how does this idea of a yield spread actually work here, linking that lower entry price to the potential returns?
But let's break it down simply. Yield is basically your annual rental income divided by what you paid for the property, your acquisition cost. Now, if you can acquire a quality unit on LMI for, let's say, $1,000 per square foot, but a similar unit in core Dubai costs $1,500 per square foot, well, that's a 50% difference in your entry price. So even if the rents on RAK are a bit lower than peak Dubai rents, that huge difference in the denominator. The purchase price means your net annual percentage return, your yield, is likely to be significantly higher than in those compressed mature markets. That's the yield spread advantage in action.
Okay, let's shift focus a bit to the developer themselves. BNW Developments, not exactly a household name yet. What's their angle? What makes them different?
Yeah, they're characterized in the analysis as a boutique developer. Their strategy seems to be very much design-led and lifestyle-focused. So unlike some of the bigger players known for maybe high-volume, rapid construction, B&W appears to be emphasizing architectural quality, creating branded experiences, and focusing on financial structures that, align with an investor's journey, trying to deliver a premium feel in a market that's still finding its upper end.
That boutique approach, being agile, sounds like an advantage. But it must come with risks too, especially being newer.
Absolutely, that's the trade-off. The opportunity is they can potentially innovate faster, maybe respond quicker to design trends, and potentially justify a price premium for that quality. But the flip side is their relative youth. Pelagia is described as their most significant test so far. They still need to build that robust track record, prove they can translate these ambitious plans into reality delivered on time with sustained quality after handover. The success of this one project is pretty crucial for the reputation going forward.
Right. And to put some numbers on this assessment, the source material used something called the A-Land 100-point framework. Can you give us a quick idea of what that framework actually looks at?
Sure, it's essentially a structured due diligence tool, a checklist almost. Those 100 points get divided across different categories, things like the macro environment, market liquidity critically, developer solvency and delivery capability, design quality, escrow security, stuff like that. It aims to give a fairly objective snapshot of the risk versus reward profile.
Okay, and applying that framework to Pelagia, what was the verdict, the overall score?
The total score came out at 80 out of 100, which positions it as a strong performer, especially when benchmarked against other off-plan options in the Northern Emirates at this stage.
8100. Okay. So where did it score particularly well?
Its highest score was in location strength, came in at 14 out of a possible 15 points. This really confirms the macro story we discussed. The analysis clearly recognizes AMI's deliberate transformation into a potentially high-value hub. The location itself is seen as a major asset.
And on the other side, where does the framework suggest being more cautious? Where's the risk clearer?
The metric with the lower score was rental and resale liquidity. It scored 7 out of 10. Now, the analysis notes liquidity is improving, driven by that tourism push, but the secondary market people selling their completed properties is still young in RAK. It's just, well, thinner than a very established market like Dubai Marina. The depth isn't quite there yet. It's still forming.
Okay, a 7 out of 10 on liquidity definitely signals caution. And if the developer is relatively new and the secondary market is still finding its feet, what are the absolute key milestones for our listeners to watch closely right now?
Yeah, good question. The framework flags two critical areas to monitor intensely. First, the developer delivery record, which score 15 out of 20, seeing successful handovers happen, meaning that physical delivery timeline that's the next major value driver, proof of execution. Second is escrow and legal safety, scoring 12 out of 15. Investors really need to track the final clarity on escrow account details and payment schedules. Ensuring everything is absolutely watertight legally is crucial.
All right. We've got the macro picture, the micro entry point via Pelagia, and the scorecard assessment. Let's just quickly recap the clear strategic strengths before we tackle the risks head on.
Okay, three key strengths really underpin that 8100 score. First, those structural tailwinds we keep mentioning. That committed $3 billion plus in infrastructure and tourism investment. That acts like a huge buffer. It supports long-term appreciation potential.
Okay. Second strength. Seems like the product itself.
Yes, exactly. Differentiation through design and branding. BNW isn't just selling square footage. They're aiming to sell a specific, curated lifestyle. And there's global data to back this up. High-quality, genuinely design-led developments tend to command price premiums, often, 10%, maybe 15% above standard projects. And they often sell faster on the secondary market, too. So it's about delivering scarce quality in an emerging location.
And the third strength comes back to value, the pricing.
The entry pricing advantage. We touched on this with the yield spread. Pelagia is positioned where its pricing, relative to comparable coastal properties in Dubai, should allow for potentially better yields. For investors, that means the potential for higher annual returns relative to the capital they put in. It's a fundamental value proposition.
Okay, strengths noted. Now let's put on our critical hats. No analysis is useful without looking squarely at the risks. The analysis flagged several points to watch beyond just that thinner liquidity. What's the main concern around the developer's track record?
It boils down to execution capability. Look, their vision seems clear, but the track record is still being built, as we said. Investors need to monitor construction milestones very closely, keep an eye on who the main contractor is, their reputation. We've all seen projects get delayed, especially when maybe smaller developers suddenly try to scale up significantly. Any delay in handover obviously impacts your returns and the developer's credibility. So, getting detailed, verifiable progress updates is absolutely essential.
Let's circle back to liquidity again. It's improving, yes, but what does thinner liquidity mean in practical terms for someone thinking about an exit strategy?
It means you really need to structure your investment horizon accordingly. Think liquidity evolution. This probably isn't a market for a quick flip, in and out in 18 months. The analysis suggests the market rewards patience. Holding for the medium to long term, let's say maybe 5 to 10 years, allows time for that secondary residential market in your AK to deepen and mature fully. If you absolutely need to sell quickly, this might not be the right fit just yet.
Good point. And finally, something easily overlooked by first-time investors, perhaps, the ongoing cost of all those fancy resort-style amenities.
Yes, that's the third critical risk to monitor. Service charge implications. High-end pools, branded spas, maybe concierge services. They sound great and they add value, but they are definitely not cheap to maintain. So investors absolutely must model potential service charge ranges realistically. You need to factor that into your net yield calculation. A unit with really excessive fees, say, getting above maybe $6 per square foot per year, that can quickly eat away at the attractive yield spread that drew you in. At the end of the day, net yield, after all the costs, is the only number that truly matters.
Is there maybe also an inherent risk just because so much of AMI's big tourism story seems anchored, at least initially, on the success of one very large, very high-profile project, the Wynn Resort?
That's a fair point, a valid critical tension, as the analysis might put it. The source material does acknowledge that Wynn is a massive catalyst, yes, but it's also an obvious concentration point, especially early on. I think the key is diversification within RK itself over time. If the Emirates succeeds in attracting other major corporate and leisure investments alongside Wynn, then that single-point risk naturally reduces. But yeah, in the near term, AMI's success is definitely closely linked to the delivery and successful operation of its key tourism anchors like Wynn. #outro. So, stepping back, what does this all really mean for you, the listener, the informed investor? The story of Pelagia and RK more broadly, it feels like it's part of the UAE's next economic chapter. It signals that the core markets are maturing, maybe getting saturated, and there's this necessary shift towards these edge markets, places where real growth potential might still exist without those prohibitively high entry costs and super tight yields.
It's a really compelling historical echo, isn't it? I mean, every major successful development hub we see in the Gulf today started as a calculated bet, a bet on planned infrastructure, on regulatory foresight. the huge capital flows that literally built modern Dubai. People were skeptical about that once. RAK and AMI seem to be at a similar kind of inflection point now, perhaps with the advantage of lessons learned from those earlier cycles.
Absolutely. The investment outlook here really requires, I think, clarity and patience. The potential upside doesn't come from hype. It comes from securing that early stage position, getting in while the market is still aligned with these powerful macro trends, that dedicated infrastructure spend, the growing demand for lifestyle destinations, and the supportive regulatory environment.
So here's a final thought for you to mull over. Real estate investing, fundamentally, is often about anticipating where value is likely to migrate next, usually driven by infrastructure and scarcity. Think about how that combination, the massive government investment plus the simple fact that premium coastal land is inherently limited, how that might dictate future value on Al Marjan Island.
Right? Is AMI just another development project, or is it a strategic foothold? The analysis we've looked at strongly suggests it's the latter. It's structured to potentially reward those who recognize the signal, that quantifiable price gap, the structural investment before the crowd fully arrives. The investor's job now, well, it's really about monitoring the execution of that ambitious vision.